It's 4:01, Anirudh. I think in the interest of time, we should start. So, good afternoon, ladies and gentlemen. On behalf of PL Wealth, it's my privilege to welcome you to today's webinar. We truly appreciate you taking time to join us, and we thank you for your continued trust and partnership. At PL Wealth, our constant endeavor is to provide our clients with timely insights, expert perspectives, and well-curated investment guidelines and guidance that support an informed decision making. And we are pleased to host this discussion at a time when global markets, geopolitical developments, and domestic policy shifts are creating both unique opportunities and new complexities. We encourage you to stay engaged throughout the session. Please feel free to share your questions via the chat window, and we'll address them during the Q&A segment as soon as we, get Anirudh to present his outlook. So we have today with us Mr. Anirudh Naha. Anirudh is one of the most respected equity and alternates investment professionals. He comes with over 22 years of experience spanning public equities, PMS, long only and long short strategies, and multi-asset mandates. He's known for his very sharp bottom-up stock selection and discipline process, very strong long-term performance track record, and he plays a significant role in shaping the PGIM alternates platform. In his current role as CIO PGIM. Anil took over this position in April 2023 as the CIO alternates at PGIM, and currently manages close to 1900 crore. Do correct me if I'm wrong, Anirudh. Close to 1900 crores across AIF and PMS strategies. And continues to see that platform grow. Prior to this, Anirudh was the head of equities at PGIM, and he used to manage the PGIM India Mid Cap Fund, PGIM India Small Cap Fund, PGIM Flexi Cap Fund, and the PGIM India Balance Advantage Fund. And all of these funds saw significant performance consistency and risk-adjusted returns during his stint there. Prior to PGIM, he was the portfolio manager and head of equities at Avendus Wealth Management. And his other stints include, fund manager profiles at IDFC Asset Management, Mirae Global, and DSP BlackRock. He's known for his high conviction stock picking, quality buys, and strong focus on fundamentals, governance, and sustainability, which is what he's put together in his current stint in some of the funds that he's managing. Anirudh, on that note, I will request you to, get in and share your perspective on, the markets, the outlook, the emerging trends, and probably we will touch upon some thoughts on how you are structuring the portfolios, given that small and micro cap as a segment are keenly watched and have now gained significant share of client wallets. So very keen to hear your thoughts, your outlook, and obviously after that we will open the floor for questions.
Sure. So firstly, thank you. Good afternoon, ladies and gentlemen. Thank you to PL for giving us this opportunity, and thank you, Rajkumar, for your kind words. So to start off, let me take you through our thought process of what we are seeing in the markets. And post that, probably we can talk a little bit about what we do, process, and the products available, and we'll throw it up for questions. I won't take much of time, probably, and then we'll try and make it as interactive as possible. Okay, so in terms of what our view on the markets are, I generally like to speak about the risks before talking about what can the return expectations be. Okay, and that sets the floor to our thought process also. We generally try to be aware of what risks are there and then probably take it forward from there. So today, when I look at it, just mind you, I think when we look at the equity markets are a far smaller market than probably what the global currency and the global bond markets are. And hence, when we fish in the equity markets, we frankly do not realize how big the fixed income or the currency markets are and what implications can happen. I have generally been come from an economics background, and I've been on the fixed income side also very early in my career, and hence try and have a perspective around currency, global bond, etc. Now, so coming to that, I think so. Frankly speaking, if I look at India specifically, I believe, or our thought process is India per se. If it was it's an oasis, frankly speaking, in what I see across the world in terms of how well it is positioned. Uh, the the balance sheets are clean today, corporate India. The only problem that probably we have at our at PIGIM with regards to India is some pockets are expensive. There is no two ways about that, and that is the only reason probably we try and avoid segments, sectors, etc. But when I look across the world, from a risk perspective, India is reasonably well insulated from any risk which arises from India per se. I think India would also, get impacted if there are global events. And from global events, if I come to probably certain things that we see, one is definitely the fact, Indian household is enjoying the rise in gold prices. But when you look at it, gold has actually risen almost 50% against the dollar, which means a lot. Which means probably the reserve currency for the world has actually lost about 50% of its value within the last 6 to 8 months. And this is concerning, according to me, because that is the currency against which everything was traded globally. And you've got that literally, down 50% vis-a-vis gold, which speaks that the US economy is something that one needs to be aware of, or at least be, that is concerning, according to us. Because one is the money printing continues. There are initial signs of certain credit events happening there, and that is something which is concerning. Generally in credit, what happens is, especially credit, and today credit is a far larger market than what it was in, let's say, 2000, 2008, 2007, 2008. So, in no way am I, implying that, a 2007, 2008 is going to repeat. But it's just that from a concerning point of view, in terms of risks, one needs to be aware that these are events which are happening globally, and one needs to be aware of it. Secondly, is I think the amount of money printing that is happening, it will invariably go ahead and reflect in inflation at some point of time. And that is something that we are concerned about, because finally valuations are inverse to where the interest rates are. If the interest rates fall, invariably global valuations go up across asset classes. Okay. Now, if interest rates move up, as inflation moves up, that would be something that I would, track it very, very closely to see whether it would finally lead to interest rate cuts not happening anymore, or does the does the pendulum move from an interest rate cut to probably certain interest rate hikes also. The US Fed has clearly been cautious. They have mentioned the December cuts might not happen. So these are some of the concerns globally that are there. But when I come to India, and because we are investing into this country, let's talk about how India is positioned. I don't know, frankly, how the next 1 or 3 months are going to behave like. But if I take a holistic view on how India will evolve probably over the next 5, 10, 15 years, I remain extremely confident, extremely enthused about the fact that India will do exceedingly well. Now I'll come to not the macros. I think that there are a lot of pundits on the macro part who would give you a 30,000 square feet, 30,000 feet, picture of how India is, etc. Let's pick it up the other way around, the bottom up approach. Okay. When we evaluate a company or a country, we basically go through the balance sheets. Okay, so if I look at India on a bottom up basis, trying to evaluate how India is positioned, I will look at four balance sheets to figure out how India is positioned in that sense. Okay. The first is the corporate balance sheet of India. Generally, we look at the listed space and evaluate almost the top 4,000 companies in terms of the balance sheet. Okay. Uh, I can tell you that I've been in this markets for almost 22 years. I haven't seen balance sheet so clean in corporate India across market capitalization. And by clean, I mean deleveraged or without debt. In fact, we were pleasantly surprised when we did an exercise of evaluating bucketing the small and micro caps on one side and the large and mid cap on the other side to see where the leverage is higher. The large and mid cap have a higher leverage than the small and micro caps, okay, on a debt to equity, which is basically saying that the resilience in corporate India is extremely high. Okay, and hence the chances of a bankruptcy happening or companies going bust are very, very unlikely. Unlike 2007, when the balance sheets were extremely extended, this time around, balance sheet strengths are very high. What surprises us when we go down to investing into or looking for companies in 1,500 crore market cap company, that company, instead of having debt, generally what it used to be, is having actually probably a 200 crore or 300 crore cash lying on its balance sheet. And that is something which really, really interests us. So the first balance sheet of India, which is the corporate balance sheet, is extremely clean. The second balance sheet is the balance sheet of Indians staying in India. That's the retail balance sheet or the individual balance sheets. Again, there are certain signs of incremental growth in leverage, where people are taking, personal loans, travel loans, these, etc. But we are still at a very initial stage, because when I look at it vis-a-vis the overall balance sheet that is there, we are still very, very under leveraged at personal balance sheet levels vis-a-vis where the globe is, where the world is. Okay. And the other good thing that has happened is there has been a wealth effect of gold, which I talked about, which has percolated down to every Indian home that we can think of. Because Indians generally have been savers in terms of gold. So to that extent, there is a wealth effect which finally, pushes up the PNL and or at least the book value of your balance sheet. So the balance sheet gets that much more firepower out there. So again, the second balance sheet is clean. There are initial signs one needs to be wary about, but still very clean in that sense. Third is the government's balance sheet. Again, this balance sheet is probably far, far better off than balance sheets that we have seen probably a decade ago or probably 5, 7, 10 years ago. No, the revenue streams are good. The government, central government leverage is actually trending downwards. The fiscal deficit that they talk about, bringing it down to about 4.4% of GDP from a 4.6, is clearly a reflection of the government's discipline and the balance sheet strength being there. So that's the third balance sheet. Again, very good vis-a-vis its own history. And the last balance sheet is the banking balance sheet. Okay. Now, this balance sheet also, Indians generally, the RBI, Reserve Bank, has been far more stringent than what the World Bank or other central banks have been in terms of maintaining balances and the kind of leverage that you can build on. Okay. So from that perspective and from the perspective of asset quality also, the asset quality perspective, I think we are reasonably pristine in that sense, including public sector banks today. And hence, from that perspective, I look at the fourth balance sheet, again, very clean. Now, think of this world across balance sheets, across countries. There is hardly a major economy which has probably one or two balance sheets clean. The rest of them are all reasonably fractured in that sense. If you look at the US government's balance sheet, it is in a bad shape. Japan is in a bad shape. Europe is in a reasonably bad shape. Chinese personal balance sheets are in bad shape. Okay, the banking balance sheet is in a bad shape. And in all this, you've got a country like India where you've got reasonably four good, clean balance sheets, which at least I haven't seen in my last 22 years. Okay. And that gives me reason to be very enthused about how India will perform. See, the balance sheet, frankly speaking, is like the foundation of your house. Stronger the foundation, the bigger the house you can build, the more beautiful it looks out there. Same would be the case with probably the balance sheet in India. And hence, with a strong balance sheet, whenever growth comes back, it can come back very, very strongly. And hence we remain extremely positive on a view. If you take a couple of years view, 2 years, 3 years, 5 years, or even a 10-year view, unless and until the balance sheets are not uh, leveraged up too much, I think so. We are in a very good position over the next over the next decade, probably, or even longer. Now, in such a scenario, when we look at how India evolving, there are a lot of trends, themes which play out. Given that India is a young population, there is a long runway for infra pickup, etc. So we've identified at our place four trends which we believe have a very very long term prospects over in India, at least over the next couple of decade, if not couple of decades. Okay. The first one where we are extremely gung about is consumption, and within consumption, healthcare also. We take healthcare as a part of that discretionary consumption basket because believe me, before COVID, uh, we used to see people were very underinsured in that sense to that extent. Yeah, post COVID, what we realized, even if you speak to the ecosystem that you support, probably your maid, your drivers, etc., everyone is saving some amount extra just for their health purpose. Okay, we see such reflection of healthcare coming through not just in hospitals or medicine, pharma being bought, athleisure. Okay, it's a reflection of how people have become that much more conscious about their health. Diets that have come through, okay, and how dietitians are doing. They're doing very well, actually. So some of these, we believe this is just the start, and India is still a young population. Think of it when we age, probably 20, 25 years down the line. Healthcare will become even bigger in that sense. So that's one trend we are extremely positive on. Healthcare is a part of discretionary consumption, according to us. Okay. And in discretionary consumption, we are extremely positive. It has gone through some amount of slowdown because the economy was going through a slowdown. But we believe if someone takes a 3, 5, 10-year view, as per capita GDP moves up in the country, you are going to see discretionary consumption go up. What is discretionary consumption? Any consumption without which your life carries on. But since you're earning more, your wealth effect is there, you will go ahead and probably buy an extra pair of shirt, probably extra pair of dress, eat outside more often, probably buy an vehicle, two-wheeler, four-wheeler, anything which is not needed. But since you have the luxury of doing it, you go ahead and do it. It's white goods, electronic items, mobiles, etc. Everything is a part of discretionary consumption. We believe we are at that stage where this as a trend can really pick up over a period of time. Okay. And hence, discretionary consumption along with healthcare is the first trend that we are extremely positive about. The second one is basically the investment cycle pickup in India. Okay. Now, the balance, what had happened in 2007, 2008? Why did the investment cycle pick up, fizzle out? Because what had happened was corporate India went ahead and invested almost 4x of their base in 3 years' time. Uh, and then it took them almost a decade to digest. And this growth that came through in investment came through largely from leveraging their balance sheet or taking debt. If your audience is there, if they can remember, there used to be 90 is to 10 kind of projects being funded at that point of time. 90 debt, 10 equity. So those took time to wean off. But today corporate India being in a far far better position with the government focusing on the investment cycle pickup coming through, we believe we are very very well positioned. Plus the PLI schemes, etc., trying to bring manufacturing within the country. So manufacturing and infra will be the second trend we believe. I don't know whether it has a decadal story or not because these are cyclicals, but at least for the next 5, 7 years, we believe there is reasonable amount of growth that will come through. That is the second part of it. Uh, Third part of the trend that we are extremely positive on is, the financialization of saving, of which probably PL is a part, we are a part of it, and anyone investing. Very, very surprising. And this is, I mean, the way, invest in a personal portfolio, uh, the amount of investment oriented savings they have started picking up, the SIP money, etc., that is coming through is all a reflection of money moving away from traditional savings into real estate, gold, and savings bank to probably more money oriented or market oriented products. And they could be debt, they could be credit, it could be equity, and within equity, it could be any of the formats that you see which are available. I wouldn't say this is a great time to immediately jump in. But if someone wants to build a long term portfolio, spread out your investments, I think a lot of money can be made out here. That would be the third trend that we'll be positive on. And fourth, and very interestingly, a large part of it still lies outside the listed space, is the digitalization and tech part of it. Okay. By this, I don't mean the Indian normal IT services. Okay. They are not really tech. We are increasingly seeing a lot of companies getting listed. There are niche areas where there are tech companies. You- And India has the know how, the knowledge to go ahead and actually advance these segments. Okay. And this, I think, again, over the next 5-10 years, has the uh, this thing wherewithal to emerge as a large segment where development, where spending on technology and hence advancements that will happen is something that will happen that can actually take it up. So four trends we are extremely positive on. Now, within that, if you talk about defense, railways, etc., we categorize them as the investment cycle part of it. Okay, for the country, there would be similar small trends here and there, but broad four trends. If someone wants to play with a 5 to 15 year or 5 to 20 year period, these are the four trends that we invest into. So that's the view on basically India. Coming to valuations, there are pockets of valuations. There are pockets which are still reasonable, but there are generally the market seems to be a little expensive today. Okay, especially the mid cap space. Now, the reason why we say that is the mid cap is a basket of only 150 stocks as defined by the regulator. We will not get into a realm of debating whether that's right or not. But it is 150 stocks, and you can understand there are so many mid cap funds out there. The large cap fund manager looking for alpha jumps into a little bit into the mid cap. The small cap fund manager looking for safety jumps into the mid cap. So the amount of flows that are coming into the mid cap segment vis-a-vis where earnings growth in this segment is makes it a little difficult to find good value businesses at the right price in that sense. Okay. If you ask us the pecking order, the general pecking order would be large caps, followed by small and micro caps, followed by mid caps. But for us, because of the fact that small and micro cap is a humongous universe, we go down to 500 crores of market cap while in building portfolios for investors in terms of the in terms of the market cap. Uh, and hence, for us, the universe of stocks available in the small and micro cap segment is far, far larger. And given the fact that me and my team we have been working in this area, we are reasonably comfortable even now building into these segments. We find a lot of value out there. So for us specifically, probably the small micro cap is followed by the large caps, followed by the mid caps. Uh, so that is on valuations. What we suggest to investors and what we have been suggesting to investors over the last 1 year plus is incrementally, I think so. We have gone through the worst part of the earnings pain. Last June, we wrote out to investors saying that probably the next 1 year, you won't see much of an earnings growth. And given where valuations are, you won't see much of a return happening. It's been now almost 1.5 years from there, and it'll probably be another couple of quarters. So the 4 years of phenomenal return which happened between 2020 and 24, I believe that it'll take about couple of years to digest that. And that is the 2 years that we are going through, 1.5 years gone by, another 6 months to go. So what we've been suggesting to investors, and we continue to suggest, please spread out your investments. If you find a good business, if you're good at stock picking, well and good. Otherwise, if you're coming in through a fund, ETF, or mutual funds, PMS, AIF, please spread out your investments over the next 9 to 12 months. I think that the experience for you would be far, far better, because India might be reasonably safe, but just as one gentleman pointed out, the markets might crash in the US, etc. There are fears because very, very clearly, the leverage which is there, especially the government leverage and the printing of money that's happening in the US, one needs to be careful about. There was an interesting question yesterday, which was asked to me was, how do you allocate across markets? Believe me, where today growth is and where vis-a-vis growth, where earnings are today, I think US and especially US tech are some places where I would be a little careful about, especially for companies where cash flows are not there. Okay, and lots of the US companies are there where you have got phenomenal stories, but you don't have cash flows supporting it. If you ask me, I think so China would be a very interesting play. India would be a great play to build portfolios. Don't expect too much of returns in the next 6 9 months, but if you have the patience, and that's what we keep saying, next 3 to 5 years, we believe India will be a very very good place to go ahead and build your portfolios over a little longer period of time. Just last 4 5 minutes on what we do and our process, and then we can completely throw it open to questions. What we generally do in our investing, and this is we've done it through cycles, is when we are investing, we first try and see for ourselves what are the risks. Okay, because investing, according to us, is return of capital is more important than return on capital. Okay, people believe, people always talk about returns in equities. I think a good starting point would be, okay, along with returns, what are the risks associated with it, and what is the downside to it? So if I can try and uh, protect the downside into a down cycle, as well as try and capture some part of the upside over cycles, such a style has always outperformed styles which completely focus only on the upside. Okay, because the downsides are equally dangerous out there. So to that extent, focusing, trying to protect the downside, how do we do that? Our process is divided into three parts. It's first safety, second growth, and finally valuations. From a safety perspective, we focus on cash flows, operating cash flows. So operating cash flows are cash flows generated through the operations of a business. So that's the first part of it. Okay, we generally like to invest into businesses where through and throughout, maybe with the exceptions of couple of years or 3 years, etc., the operating cash flow is positive. Okay, it means that through cycles, if a business have been able to generate cash flow from its own operations, that speaks a lot about that business. And believe me, businesses go through cycles. Okay, so that's the first one. Secondly is the leverage on the balance sheets. Generally, we believe corporate balance sheets today are very clean, so nothing much to worry about on that part. And the third thing and very important part is who is the promoter and what is his alignment to the minority shareholders. This is of great significance, especially in the small and micro cap space. And that's something that we would want to always be wary about. And to verify that, the last thing we do is meet the promoters. Okay, because we try and figure out a lot of things about the company promoter, and the fact that I've been in 22 decades plus in this market, in this segment, has helped me with experience. But we've got a lot of processes, checks and balances. Our analysts are chartered accountants and CFAs who understand, chartered accountants and yes, CFAs who understand numbers very well. So we dig into numbers. And the final this thing that we fall back on in terms of trying to verify where we like a business, but we are not sure about the promoter, we go ahead and get forensic audit done as and when required. Okay, so that's where we end with the safety part of it. Growth is bottom up largely. Okay, we focus on a lot of things, try to buy good businesses which are going through the bottom of a cycle. Invariably what it does is, since it's going through the bottom of a cycle, it is ignored. Valuations have come off, ROE, ROCs are depressed. And that is where if I go ahead and buy a good business with a 2 3 year view henceforward, and if our calculations of growth coming back are right, you enjoy ROE, ROCE expansion, you enjoy earnings growth, and you enjoy the third thing, which not many people talk about, which is PE expansion. Okay. And that is where I think the whole return perspective, it is earnings growth as well as PE expansion both together. And that is what we try and do. And finally is buying a good business at the right valuation. And this is something which the markets have taught us over the last 3 4 years. I have seen it through cycles. There is no use of buying a great business at any price. You invariably go ahead and don't make returns. Okay, you might own amazing brands, but they don't end up generating returns for you. So that's the whole process. The one product we run, two couple of products. One is called India Equity Portfolio, which is based on the 4 trends that we talked about. So any investor coming in there would participate in a portfolio of about 25 names across these 4 trends that we like. And the other one is a small and micro cap PMS that we run. where we believe our expertise, we are able to show disproportionate allocations to businesses which we like. We run it. There are two segments in that also. One is a segment where we run it with about 20-25 names. It gives a lot of comfort to many investors. But then there are some of these promoter families, HNIs, ultra HNIs, who love to see 10 stocks, 10 to 12 stocks. So we go ahead and build a 10, 12 stock portfolio even there. So that's from my side, Rajkumar. So we've talked about the markets, our process, as well as the products. Very happy to take questions.
Thanks so much, Anirudh, and I think very well covered. Few questions from my side, and these were points that I noted down when we were having this discussion. So, from your, the decadal theme, the four themes that you were mentioning, how deep is the small and mid cap opportunities in all of these four segments? I mean, we're used to seeing a lot of opportunities in the large cap and possibly in the mid cap space, but how deep is the opportunity in the mid and small and micro cap segment?
Sure. So let me put it this way. Actually, these are two exclusive areas. So where the small and micro cap is picking up anything and across everything. Okay, we don't look for trends. Whereas the IEP, which is the India Equity Portfolio, is a multi-cap strategy which we run across four trends. Okay. So, but to answer your question, are there trends which can emerge within? Are there good businesses in the small and micro cap which participate in these trends or not? Okay. Believe me, there are amazing trends which we believe will participate or do participate to that extent. Okay. Um, Now, without naming companies, etc., when I look at the tech segment in India, okay, digitalization part of it, pure tech companies more are largely in the small and micro cap, if you think of it. If you take away the IT companies, etc., and you take out the digital platforms, etc., many of them actually survive in the small and micro cap with a great opportunity to capture things outside over a period of time. I'll give you, without again naming it, give you a sense. Holiday, going out for holidays is a great thing that people are enjoying today because of the availability of extra income coming through. Uh, when you go ahead onto platforms to book your tickets, whether it's the flight ticket or the hotel bookings, the more number of times you start checking out certain properties, the price invariably moves up. And this is actually an a tech company which is tracking your IP address, trying to see how many times you go, and then there is a dynamic pricing that goes on behind it. That same property, if it is checked through a mobile which hasn't gone and checked that property so many times, the pricing could be very different. Now, this dynamic pricing for some of the world's best holidays and airlines is managed by an Indian tech company. Just to give you a sense, it's a small cap again. So there are interesting plays. The only thing which I tell investors who come into the small and micro cap side it's very exciting. But please be ready, and especially in the last 4 years, we haven't seen drawdowns. So please be ready for a 20% or 25% drawdown any point of time. If you are ready for that, then you will enjoy the upside also happening out there. Okay. So for whatever safety measures we might take, if there is a global event, small and micro caps could be down 20% in no time. If mentally, if you are prepared, and the second thing, if you spread out your investments in the next 6, 9 months or 12 months, I think so the journey will be far, far more palatable. And the wealth creation, this thing can actually be humongous over the next 5, 10 years.
Very interesting. You did, touch upon earnings growth and cyclical earnings, etc.
मेरे को
Bloomberg data
मेरे को रॉकेल
shows
पेट्रोल
that, sorry,
थिनर का भी अच्छा
can
वाइटनर
we
Sorry.
have
I
ourselves
think-
on mute, please?
वाइटनर
Okay, sorry, I can.
Yeah.
Okay, Bloomberg data has shown that cyclical earnings revival in 26, 27, CY 26, 27, with about 22% EPS CAGR for Nifty small cap 250 kind of index. Does this align with what you're seeing in your investee companies? Are bottom-up indicators supporting this narrative?
Yes, absolutely. In fact, even in this couple of quarters that we have gone by, it is, I won't say broad-based ETF would or a benchmark would give you those returns. You have to be very selective. But believe me, if you buy a good business going through tough times, you invariably, and you'll have to build in a model of the next 2 quarters, 3 quarters, and the next 2, 3 years. If you can go ahead and pick such businesses 1 or 2 quarters ahead of that recovery, you invariably enjoy the full journey. Now, that is where the full skill set of our team comes in. We try and do it. I won't claim that we are successful. Some of the cases where we actually go ahead and sell off the businesses is we wait for 4 quarters, and if it doesn't come through, then we realize we've modeled it wrong, and then we go ahead and sell it. The good thing for our team is we don't generally, in the last almost 10, 12 years, we've not made a mistake on a promoter. That's the checks and balance. Now, coming to earnings part of it, I think so earnings, mid, small, and even large caps into FY27 will surprise a lot of people. We are seeing those initial trends across sectors, across market cap. Okay. And hence, if there is a broad-based recovery, generally, I think it will be very interesting to see businesses or companies where earnings have not come through till now. And there, the potential of earnings catching up can actually be very interesting.
So just a follow-on question on that, with tax cuts, capex continuity, inflation probably coming in at the lowest in at least my recollection over many years, and with a stronger monsoon, domestic demand is expected to revive and do well. Which are the small cap sectors that you think are very well positioned to ride this cyclical revival? Because a lot of themes that you said in terms of consumption, discretionary consumption, digitization, a lot of them probably are the larger cap companies. So do you see such trends, or which other segments do you see those kind of
Sure. See, actually, in a small cap, we rarely talk about sectors, frankly speaking. A single company might be a sector. That's the opportunity I wrote there. But even if you ask me, let's say a revival in agro, rural India is something we believe has started happening, and will continue to do reasonably well into the next year. The water tables are good, rural economy is doing well. The payouts that are coming through from the government side has been good. So anything related to the rural economy, we believe is a segment which can turn out to be very interesting. It's a segment which has literally been ignored for the last 1.5, 2 years, actually. Okay, so that could turn out to be very interesting. Let me give you another sub-segment of discretionary consumption. Something like QSR. People have completely forgotten it. And many of them are actually small and micro caps out there. Small caps and probably smaller mid caps. Over the next 3, 5 years, I think so. That could turn out to be very interesting. Okay. Um, Chemicals is something that we are tracking very closely. The balance sheets are good. The capex is over. If at all we foresee some amount of lower intensity in competitiveness from China, I think things can really revive. And we are seeing initial signs of that in some segments coming through. Okay. Other than that, as I said, if the four themes, if I have to pick cap goods today, or a revival in metals. Okay, so metals and mining companies are doing well. Now, there are no small and micro cap metal companies per se, or mining companies in India. But there are a lot of small and micro cap equipment suppliers into that value chain, and they can turn out to be very interesting. So there are segments for sure, and it is reasonably spread out. On the pharma side, I think so. CDMO is something which is caught the fancy. GLP-1 is caught the fancy of a lot of investors. Now, in that value chain, are there businesses which are small and micro cap out there, or even mid cap for that sake? If you take a 4, 5 year view, and are ready to be patient for the next 6, 9 months, even within mid cap names, you will find very, very interesting names coming out. And hence, from that perspective, I think the opportunity is there. It will all be how patient you are, what is your conviction and them. And if you can sit through for the next 5, 6 years, I think the wealth creation will definitely happen.
what about sectors like you've listed in your investment strategy sectors like water treatment and probably niche marketing, recycling,
Sure.
healthcare equipment, etc. How some of these are off benchmark sectors.
Right.
So how excited are you about these over the next 3-5 years, and why?
Sure. Sure. So see, these opportunities are humongous. Okay, because I think there will be dearth of good quality water for healthcare, pharma, industrial use, as well as potable water in India over the next 5-10 years. So the opportunity can be huge. Our only way we look at it is we like to buy into businesses where their intervention from the government side is minimal. So probably their customers are not the government to that extent. They supply to the EPC contractors, etc., and hence are able to manage working capital cycle far better. Okay, those are things that we keep in consideration. But we like the space. So any company, whether it is recycling, whether it is EPC or not EPC, whether it's water, okay, some of these segments will actually evolve into very large segments. We will have to know which part of the value chain to bet on. And our learning, at least, has been to bet on businesses which do not have too much of interaction with the government. They largely participate in the private sector part of it and evolve through it. So, to that extent, these are segments that we like. Let me give you another big sector which can evolve from India over the next. It's a boring old sector, textiles, frankly speaking, and garmenting. Excepting for one company which I can think of, which is a mid cap, rest everything is small and micro. Okay. And this we believe this one's time probably has come to that extent. It could turn out to be very interesting.
Very interesting. Okay, maybe a couple of questions just come up. Many of your case studies, in your presentation deck, highlight operating leverage emerging after years of capacity buildup. You know, which of your current holdings do you see at a similar inflection point?
See, we due to regulatory issues, we cannot name them. Okay, but if you ask me as a trend, I think textiles are very well positioned. Garmenting, textiles, garmenting, etc. They're very well positioned. One change in the tariff structure, everything changes. Okay, for this segment. The chemical side, we are tracking it very closely. The amount of capex corporate in the chemical companies have done in the last 3.5 years is humongous. Okay, it's all a matter of some amount of stability in the pricing part of it, where we believe the margins, the worst is over, and then you can start betting on it with a little longer term view, 2, 3, 5 year view. There will be money to be made because operating leverage will kick in from that side. Even within pharma, small cap pharma companies, just if we just go ahead and look at what kind of capacity expansions have happened and how utilization can play out there, it can be phenomenal. Okay, one place where you don't see capacity is being added, but just purely because of the nature of the business, some of these businesses will do very well. Are platforms. Okay, whether it is financial platforms, whether it is food delivery platforms, whether it is. But having said that, we are conservative. We like to see OCF. Okay, so if I see some of these platforms and I see OCF, I get excited. If I see the platforms but the OCFs are missing, I would rather wait for the OCF to come through. Okay, because finally in the fintech new age businesses that have come through, the entrepreneur's journey has usually been through private equity, and their thought process is very different from what a public investment uh, you know uh, investor would look like. For us, uh, cash flows, operating cash flows mean a lot. For people who are investing into these fintechs, etc., without cash flows, nothing wrong in it. It's their style. They are comfortable there, and they are probably doing their job in the right way. But similarly, our thought process is we are ready to forego 10 good ideas. It doesn't matter, but the one we pick shouldn't be a mistake. And to ensure that, we focus on cash flows. So to give you a sense, operating leverage across India, I think so is very well positioned out there, and that could actually come and benefit in a big way.
There are a few questions which will also come in on the chat. One of the questions which you did allude to when you were making your presentation is if US crashes, which most intellectuals have predicted, no other country will survive, and this can be far more severe than probably the 1929 or 1932 Great Depression. Do you subscribe to this view? And if not, why?
Sure. So, see, frankly speaking, I'm not an expert on macro. This is a question where not only the equities are involved, there is currency involved, there is bonds involved, and probably a global economist strategist is far, far more well positioned. Though I have looked at it, and that was the statement we generally, I started it off that way. Now, what are the chances of something like that happening? Frankly speaking, after 1929, the only reason I would think this can happen is a decade has passed, and not decade, a century has passed, and hence it's time for the next one. Other than that, frankly speaking, yes, the world has been pushing problems down the road. The can has been kicked down. I think so. This will probably continue. Yes, if money printing stops, and sanity prevails to a certain extent, I think so. There will be pain in a lot of asset classes. And the one asset class where I believe you will see humongous pain is cryptos, probably. Okay, because they are a fallout of money printing and a new set of asset classes getting created for all the stories that go around. Okay, uh, only time will tell, but I wouldn't want to make a prediction whether the next fall, and if it is going to happen in the next 1 year, 3 year, 5 year, 10 years, is going to be deeper than 1929 or not. But yes, I can tell you, vis-a-vis 2008, I have lived through 2008. I think the leverage in the system is far higher globally. Okay, and hence to that extent, if uh, things come off, if QT happens dramatically or something comes off, the pain could be bigger than 2008 also. I don't deny that. But having said that, if I realize it, the central bankers, governments also realize it. And they will keep pushing the can down the line as far as possible. And one of the reasons why gold, silver, precious metals, and commodities are doing well is the debasement of currency which is happening. So probably this time around, the problem which we don't realize is the fact that debasement is anyway eroding your wealth. You speak to probably any of your relatives or friends staying in the US, and I did this last week. They felt they for the first time in their life they felt they were actually not building wealth because they lost 40% against gold. In fact, if you look at it, our currency has not lost that much against gold to that extent. So that's one way of looking at it. It's probably already on. Debasement of currencies are happening, and we are living through it without realizing.
That's very well said. And given the fact that, Powell is probably completing his tenure, probably another 6 months, and we could see a new Fed chair in US. And Trump has been pushing hard for a very aggressive rate cut. Uh, there's been multiple spats between the two, but given the fact that they've now even started talking about the $2,000 payouts to investors, I mean
Right.
to the public, which could again burn something close to $400-500 billion in terms of
Yes.
the lending is already at almost close to $40 trillion. It can just push it over the edge. So we've got on one side, you know, inflation probably rearing its head or already, up in there and probably can move up significantly higher in the coming months and quarters. Uh, we are also seeing, just like how India, we always make fun of the Indian subsidy systems and Indian dole out systems, but it's happening in US also now,
Yes.
and with all of that happening, do you continue to, I mean, would you see continued depreciation in the dollars going forward? And do you see that trend? Um, the question I'm trying to ask is, with Powell on his way out, do you see an aggressive rate cut cycle happening in US? And if that continues, obviously it will have its own challenges.
Yeah.
But how do you see India in that kind of a scenario?
See, one thing is whether rate cuts happen or not, the true rates are going to get reflected in the 10-year yields. Okay. And that is something that I'll track very closely. So, in spite of the rate cut that happened, yields have held on in the US, actually moved up by about 7, 8, 10 bips. And that is a true reflection of what the market is saying. See, just cutting rates is one thing, but if you're going to spend, who's going to buy your paper is the question. And people will want higher and higher yields for subscribing to such paper. So what is the government probably going to do out there? I mean, I'm just guesstimating, and that's what it seems like. They're going to issue shorter term papers and keep rolling them over as long as possible. Okay.
Which has been the norm for the last 2 years, that they've
Yes,
exactly been doing that.
absolutely. Absolutely. So to that extent, our sense is even in India, inflation is down, but we don't, my belief is India will also not be in a position to cut rates too much. Okay. One is then as a developing economy, you are converging your yields vis-a-vis developed economy. Okay. For whatever developed means today. Okay. But you are still converging it. So, and hence, uh, the appetite for money flowing in comes off. I don't think the government would want to do that. Okay. So you wouldn't see probably rate cuts happening. And in the US, even if rate cuts happen, I think it would be harakiri, frankly speaking, because inflation would nudge up because of money printing. The actual yields would be reflected in the tradable yields that are there rather than the interest rate that gets reflected out there. And to answer your question on whether the dollar keeps depreciating or not, see, dollar has been depreciating more or less across. I think the biggest depreciation has been against gold to that extent. Okay. And over a period of time, if this is the way the economy is run, my from whatever little knowledge that I have, I believe it's currency. The currency starts getting irrelevant in that case. The dollar.
In your most recent PMS newsletter, you did mention about potential redrawing of global supply chains, and you mentioned due to the US tariff escalations. From a small and micro cap universe perspective, which segments do you think will stand to benefit, and will that get captured in some of the export share that India has?
Sure. So one thing we did where we were very aware of which are the sectors to avoid in case of a tariff. I mean, we've completely been able to literally avoid it to that extent, and it has been helpful. So the first part, as I always say, first try and figure out what we don't want to do or don't want to participate. So that was right. I think the rest of the market, then we have to, run through whatever is left in the market. And a reason, the export-oriented businesses are actually largely around two or three sectors, and a few more irrelevant ones to that extent. Okay. And within, if you take out those one or two or three relevant sectors, I think there's a large enough market within the country to build your portfolios across. So we've been running, me and my team, we are running about 4 or 5 strategies uh, with literally no exposure to anything to the US. Of course, there would be some cap goods, some of the cap goods part of it. They would be, especially the MNC cap good companies, they would have an exposure to the US. But we've stayed away from auto banks, we've stayed away from textiles till now. We've stayed away from your aquaculture. We stayed away from gems and jewelries. So to that extent, we've tried to protect ourselves. Within redrawing of this thing, see, I think so. One more thing, this is a very interesting question. So, redrawing of value chains or supply chains is happening because every country is trying to pull investment to their own land and build the whole ecosystem there. Now, economics theoretically has taught us you should let the cheapest producing country produce in their own country that product, and that's why trade has thrived. Over the last almost 50 years, trade has been one of the lubricants for bringing down inflation globally. We believe that if value chains, these supply chains get disrupted, that itself will add some amount of inflation. because you will not end up being the best supplier, and tariffs and barriers will only increase the cost of production, which will get reflected out there. So it's a very interesting. I don't have an exact answer, but there are companies, segments which will benefit out of not importing from outside. The PLI schemes are a very very clear sign of that. Now, what are you trying to do? You're trying to bring the supply chain within the country, and there would be businesses out there which would benefit out.
There's one question, and you did allude to this as on the digital theme. So the question is, what's your view on the new age digital businesses under the Digital India theme, specifically relating to fintech, food delivery, quick commerce company? Do you see them as sustainable long-term investment opportunities, or do you see valuation concerns?
Sure. So both are right. They are long-term sustainable themes. In the near term, I don't see them generating cash flows, and hence probably we will give it a pass. Okay, many of these companies will take time to generate cash flows because their business models itself are evolving. Okay, so that's very interesting. Uh, Valuations are expensive. There is no two ways about it. Today, we try and justify valuation based on relative valuations. And because money is easy flowing, we do not realize that in such a flow of money and where interest rates have been subdued, you can actually expand your PEs and still justify it. But I think so that is something which might get challenged either if money supply starts shrinking or interest rates move up. And we, from a risk mitigation side, would always look at that and then decide whether we want to invest into them. Plus, the fact that cash flows in many of them aren't there is something that we've stayed away from. Without naming it, the uh, the electric vehicle company which is listed. Okay, their business models have gone through so much of change within a period of about a year's time. Okay. So this is what is something that we are also grappling, especially not taking away from their success that they have done for themselves, but businesses which come via the private equity side. We are still seeing a lot of them evolve within the listed space. See, we want to see these businesses stabilize, cash flows to be generated. And then if you take a decadal view, a 5-year view, 10-year view, you will absolutely make a lot of money out. There's no two ways about it.
No, yeah, that's well put. Probably my last question, and I don't see any other question in the chat box. In the past, we've seen winners like Trent, TTK, KEI, Dixon, and you've highlighted some of this in your, as some of the case studies, etc. What are the common traits that you see early in companies like this that distinguish these companies as multi-baggers as compared to just being good companies? I
Sure.
mean, there are lots of them which are good companies, but how do you distinguish them to become from good to multi-baggers?
Very good question. I think what we track is ROIC, capital efficiency. Companies which respect capital invariably do exceedingly well, and that is the one thing again which I mean, if you look at it, how the new generation companies have developed. Today capital is available. I think they need to respect it a little more. A respect for capital, being stingy about spending, or how you allocate capital, knowing where the end ROE, ROCs or ROICs are, is something that we would keep a very, very close look at. And when the names that you took, it was exactly that. To add to it is probably another Tata Consumer Company also. There was a time when there was absolutely no respect for capital, and we saw decades where nothing happened. And the only thing they changed was the respect, capital allocation decisions, and that really changes things for companies out there in terms of fortunes.
As we speak, there are a couple more questions which have come in, and especially on the EV space. So how do you see EV as a segment? And there's a follow-on question which says that, I'm sure you may not be able to name the companies, but if you have to bet on that space, where will you bet? Or which part of that business?
So see, I'll tell you very frankly, the differentiating factor for an EV is the battery technology, right? Okay. Otherwise, EV is as good as a scooter, a normal scooter, or a normal car, etc. Believe me when I say India's capability on the battery technology is still way off. We are probably, I don't want to give a time frame of whether we are 5 years, 10 years behind, but we are behind. Till even now, what we are doing is we are bringing battery technology within from China or importing it from elsewhere, packaging it here, and then building vehicles and just going. So, if you ask me, I would look for companies which have the technology in batteries, whether listed or unlisted. Once I spot them, I don't mind betting on them. But frankly speaking, just for the sake of playing EV, do I play an Indian name out there? I would try and figure out some global ETFs to play at least, which will give me a far better representation of these companies out.
And there's one more question from one of our guests is what's the future of Indian IT and sector? Your thoughts on that?
Sure, sure. So we were discussing this even yesterday. I remember this gentleman called Mr. Sikka. Okay, he used to throw terms at that point of time when we used. I mean, we never knew understood it, and we thought uh, it doesn't make any economic sense. If we had just persisted with that gentleman, I think it would have he would have been a doyen for India at least in that sense. We are far, far away on the technology curve, at least with these large IT companies. The amount of cash flows that they throw out, they could easily go ahead and invest in technology. Okay, even if they don't want to build it in house, they can go ahead and acquire technology. It doesn't matter. This was probably the last. If they had started it even 5 years back, or probably into the next 5 years, go ahead and buy some good technologies, even if it is loss making. Learn that process. That you could do R&D in house, or you could buy out R&D. And today, frankly speaking, you could probably buy out R&D. I think as long as we don't climb onto that R&D curve and move up, we will only be sweatshops, frankly speaking. And that's where we would be. We would be paying out dividends. We would be having cash flows, probably, no doubt. But growth in terms of technology, we would like.
Probably the last two questions, and I'm sure we just run out of time, but if we can take this
Sure.
due. One is your views on hospitality and EMS sector.
So hospitality is a part of discretionary consumption because people spend. We are extremely positive, but it is just that at this point of time, valuations are extremely expensive. Okay. Plus, we've seen a boom in spending on hospitality. For some time, we could go through a flat kind of curve, where then before the next leg of spending comes through. So we just need to be aware of where the valuations are. And same is the case with EMS. Good businesses, growth businesses. If you have bought it at the right time, no doubt, please hold it on. But if I go ahead and buy something today on the EMS space, I would be extremely careful. Same would go for another question which came through on defense side. I think it's a great story, but please understand in defense, there are long gestation projects and there are short gestation projects. Long gestation projects would be shipping, any of those things. It takes in a decade you build one ship in India in terms of capability. Okay, and there would be companies which sell consumables which you need year after year after year. So depending on your time frame, please go ahead and invest. If you are an investor who can wait for a decade for that big lumpy numbers to come through, well and good. But for what I have seen of Indian investors and generally across, people are reasonably impatient after 1 2 years. Okay, so if it is that, then focus on the right companies. I believe the sector will do very well. The spending will definitely go up. This and railways, both of them. It's just that you need to buy the right business at a right valuation, and that is where the experience of returns will be very good.
Probably the last question that we can again, one more question on the sector is BESS
Same battery.
battery.
Yeah, that's what I said.
You
We
answered
don't.
on that. Your answers are there. So maybe the last question is the view on precision engineering as a sector. And you did mention about, when you were talking about metals, you did say, equipment suppliers probably could be an opportunity. Uh, you also alluded to capital goods as being one of the sectors that you like, and probably precision engineering could be one such cases. And we've heard so many EU engineering firms have shut shop, and some
Yes.
of them are outsourcing to India. So do you see that as
Yes,
well?
I think so. And you'll find most of the precision engineering companies in the small cap and micro cap space. So we are positive. We believe there is some amount of technological or some amount of capability out there, which differentiates it. So that is something that we will keep a close tab on. There are good, very interesting companies, both multinationals as well as domestic. So I think so that's a good space to be in with a 3-5 year perspective.
Great. I think we did get to cover a lot of questions, and thank you so much for your patience, Anirudh. Uh, I think we've seriously run out of time now. We've now on borrowed time, but um, I think once again, thank you so much for
Pleasure.
taking time out today and sharing your insights and being patient with all our questions.
Sure.
And for all our guests who've logged in, thankful for your patience and time, and thank you so much for all of the questions. All of them were very insightful, and we hope we've been able to get the relevant answers to most of them. On behalf of PL Wealth, I thank all of you for taking time out and joining us today. And Anirudh, thank you so much again.
Pleasure.
Wish to get you back, at a later time
Sure.
for more insights.
Sure.
Thank you,
Thank you.
everyone.
Thank you,
Thank you for
Rajkumar. Thank you
joining.
to PL for this opportunity.
Thank you so much. Thank you, everyone.